What financial reports should pop-up drink stands review monthly? A pop-up drink stand should review its profit and loss statement, its cash flow report, and its inventory and cost of goods report every single month to stay financially healthy and catch problems early. Think of the profit and loss statement like a report card that shows if you made more money than you spent that month. The cash flow report is different because it shows when money actually moves in and out, since you might look profitable on paper but still run out of cash to buy cups or syrup for next week. The inventory and cost of goods report tracks exactly how much every drink costs you to make, including ice, cups, straws, and labor, so you know your true profit per cup instead of just guessing. Something a lot of stand owners never think about is tracking spoilage and waste separately, because melted ice, spilled syrup, or expired fruit can quietly eat away at profits without ever showing up clearly on a basic sales report. A smart trick is to create a simple waste log every week and compare it against your inventory report monthly, because that tiny habit often reveals leaks nobody notices until the money is already gone. One big caution is mixing personal and business expenses together, since that makes your reports useless for decision-making, so open a separate bank account just for the stand. Another thing to watch closely is seasonal swings, because a slow month can look like failure when it is actually normal, so compare each month against the same month last year instead of just last month. Finally, always double-check your card processing fees line item, since those small percentages quietly add up and many owners forget to include them when calculating true profit. If you enjoyed this video, check out our online directories in the description below.